Good morning. It's John Mousseau. I am the President, CEO, and Director of Fixed Income here at Cumberland Advisors. It is Friday morning on November 6th. We still don't know who's president yet. It is looking like it will be Vice President Biden, but there's still votes to be counted, states to be sorted out. It does look like we'll probably have a Republican Senate, although that is not for certain. But in any case, the idea of a blue wave has been taken off the table. What did this mean for bond markets? Not much change net. Where are you? You started the week at 85 basis points or so on the 10-year bond yield. You're roughly there right now. You started the 30-year at around a 165. You're at a 160 now. In between there, lots of volatility. 10, 15, almost 20 points volatility up and down. That's a lot. Why did you have the volatility? You had the volatility because of the uncertainty as you went into the election. As you got to the end of last week, yields higher, looked a little more clarity like a blue wave. Clearly on election night, that was taken off the table. Yields started to come down because divided government means probably less spending overall, harder to get things through. So the kind of inflationary expectations that we talked about last week are probably a little more subdued for now. On the muni side, what did that mean? That meant supply was almost non-existent this week. We talked about that last week. Last week was $20 billion in what we called visible supply. This week it was $5 billion. Next week it's like $7 billion. This is because all the issuers rushed, and I mean rushed, during October to get deals to market, to beat the election, to not repeat the volatility that they saw 4 years ago. We did see 4 states pass marijuana legalization. That was Montana, Arizona, New Jersey, South Dakota. Without getting into the politics of marijuana, why did they pass it? It's easy. The revenue that they get from legalization. It's that simple. On the economy, more good news. Initial jobless claims down. Unemployment rate down below 7%, down to 6.9. That's the first time in the pandemic that we've seen it cross the 7% threshold. That's all good. We're going to look next week at PPI, CPI. Again, look at initial jobless claims. We had the Fed this past week. Didn't change a thing. One thing to think about a little bit is in a world where you're going to not have everybody lined up, House, Senate, White House, on the same side, the Fed's role will probably be more in jawboning. They said yesterday they stand ready to have to buy more treasuries and mortgages if needed, but you'll certainly see them try to prod what will now be a more divided government to try to push on a second stimulus bill. And that will probably be, you'll see Jay Powell probably trying to do that going forward. We think that by next week we should have an answer on the president, have a little more clarity in the markets, and have a little more forward guidance in terms of where we think rates are going. Our baseline is that as you get a new administration, most likely next year, you will start to see economy return a little higher, hopefully a vaccine, a little better, and eventually spending, and more importantly, the turnover of spending, the spending rate going up. Remember, we have a very high savings rate in this country. Everyone's been staying at home. That will start to change. That should start to bring inflationary expectations a little higher, but that's for next year. We'll see you next week.